Have you ever noticed those companies that are rarely in the headlines, but they're absolutely fundamental to how our world runs? They quietly build entire empires by doing one thing exceptionally well, no matter how, specialized it seems. Imagine the tiny critical component that, if it fails, brings a multi-million-dollar operation to a screeching halt. Today, we're diving deep into one of those, well, fascinating enterprises. So, okay, let's unpack this. We're talking about a company that has moved far beyond simply selling products. They've managed to embed themselves so deeply into their customers' operations that they become truly indispensable, almost like an extension of the customer's own teams. That's the intriguing story we're exploring today. We're going to shine a spotlight on Diploma PLC, listed on the London Stock Exchange as DPLM.LSE, an international group you might not know by name, but whose strategic approach to specialized distribution is, frankly, remarkable.
Yeah, and our mission today is really to cut through the layers of investment analysis, get past the jargon, and extract the truly core insights from the sources you've shared with us. We want to give you a comprehensive understanding of how Diploma not only operates and grows, but also consistently creates significant value. So we'll delve into their unique business model, their powerful dual-engine growth strategy combining, organic expansion with really disciplined acquisitions. We'll look at their impressive financial resilience and what genuinely elevates them into, well, a high-quality, high-performing enterprise. What's particularly compelling, what we'll uncover, is how this company provides mission-critical technical products and services across incredibly diverse industries. It truly earns its description as a distribution group with a difference. And perhaps the greatest paradox we'll unravel today, how it manages to be a remarkably capital-light business that consistently delivers compounding growth and sustainable operating margins above 20%. You'll soon see why that combination is just so potent.
So let's start with the fundamental question. What is Diploma PLC? I mean, we know it's FTSE 100 international group, but it's crucial to understand it's not a manufacturer. You often describe them as a distribution group with a difference. What exactly is that difference? What sets them apart from just any other distributor?
Right, that's the perfect place to begin. The core difference, the real essence of Diploma's identity, lies in what they call their value-add wrapper. Think
Right.
of it this way. They don't just move boxes of parts, no. They take specialized, often low-cost components items that individually might seem insignificant, and they enhance them dramatically. This enhancement comes through deep technical expertise, bespoke customization services, really efficient kitting, which means creating pre-assembled, tailored kits of parts for specific customer needs, and exceptionally responsive customer service.
Ah, okay. So it's not just about the product itself, but everything around the product, the service, the know-how.
Exactly. Spot on. The key insight here is that the value they add for the customer in terms of ensuring operational efficiency, significantly minimizing costly downtime, and reliably solving complex technical problems often far exceeds the actual cost of the component itself. For their customers, having the right part with the right support at precisely the right time is paramount. It's critical. This approach fosters incredibly strong customer loyalty and, crucially, grants Diploma significant pricing power. So for you, the listener, the takeaway is simple. It means their products, though maybe individually inexpensive to the customer, become absolutely indispensable, mission critical. This leads to highly resilient and predictable demand for what they offer, even when economic conditions get tough. Because look, a failed part isn't just an inconvenience, it's often a complete shutdown.
That makes perfect sense. Yeah. They're solving much bigger problems than just sourcing a component, aren't they? And this value-add wrapper sounds like it's deeply integrated into their operational model, which, as you said, they famously called their secret sauce. What does that look like in practice? How does a company of this size maintain that kind of agility?
Well, it really boils down to their radically decentralized culture, which is indeed their secret sauce. It's quite unique. Each of Diploma's business units operates with a remarkably high degree of autonomy. It's quite something. This means they intentionally preserve the local brand, their unique identity, and crucially, their existing leadership teams when they acquire a business. This approach fosters an entrepreneurial spirit, it keeps things agile locally, and maintains that deep specialized market expertise, which is just vital in their niche sectors.
So the central headquarters isn't dictating every little move then. It's not top-down heavy.
No, far from it. The central corporate function is intentionally kept lean. very lean. They focus purely on strategic direction, overall performance management, and perhaps most importantly, smart capital allocation across the entire group, making sure the money goes to the right places. They really try to avoid bogging down individual units with bureaucratic control. It kills the magic. Now, this model is exceptionally effective when they acquire privately owned businesses. Why? Because it preserves that existing culture and, critically, the management talent that built the business in the first place. You don't want to lose that. So, for founders looking to sell their successful enterprises, Diploma becomes a highly attractive buyer. They offer a permanent supportive home for their legacy without disrupting what made them successful. However, it's worth noting the inherent challenge here. Preserving this distinct entrepreneurial culture as the group scales and acquires larger, more complex businesses is an ongoing test. It's a balancing act. Can the model scale without losing its essence? It requires constant vigilance to prevent that central blob from growing too large and slowing things down.
Right, it's a delicate balance. So they built this incredible operational model, the secret sauce that empowers local teams. But what kind of ingredients are they actually working with? What specific markets are they tackling with this decentralized value-add approach? They've strategically diversified into three main pillars, haven't they, to spread the risk?
They have, yes, and this diversification is a key part of their resilience. It's very deliberate. Diploma strategically spreads its portfolio across three main reporting sectors: controls, seals, and life sciences. Each plays a distinct role in the overall health and growth of the group. So first, the control sector. This is currently their largest and notably their fastest growing segment. It's really the engine right now. Here they supply specialized wiring, intricate cables, various types of connectors, robust fasteners, precision control devices, and high-performance adhesives. Now, these are far from generic items. They're designed for technically demanding applications in critical end markets. Think aerospace and defense components for aircraft, military equipment, that sort of thing. Also, essential infrastructure projects, energy systems, medical devices, rail transport in these high-growth areas like advanced data centers and even elite motorsport. This sector accounted for a significant 52% of group revenue in their last fiscal year, FY24. That's a notable increase from 47% back in FY22. So it really underscores its pivotal role as a growth engine, heavily driven by those powerful structural tailwinds we'll definitely discuss later, like the booming demand in aerospace and the expanding data center infrastructure. Huge trends. Next, we have the seals sector. You can think of this as the industrial workhorse of the group. Solid, steady. This segment provides high-performance sealing solutions, various gaskets, cylinders, hydraulic hoses, and fluid power products. Very industrial. Its markets are heavily tied to the maintenance, repair, and overhaul, what we often call MRO needs of heavy mobile machinery and industrial equipment. You'd find their products in vital sectors like mining, agriculture, large-scale infrastructure projects, and energy production. Essential stuff. This sector contributed 32% of group revenue in FY24, which was a slight decrease from 35% in FY22. And that really reflects a more modest growth profile compared to controls, given its closer ties to, well, cyclical industrial activity and maintenance schedules. And finally, the life sciences sector. This represents their healthcare innovator, a really interesting area. This segment sources and supplies essential medical devices, sophisticated diagnostic instruments, specialized laboratory consumables, and related support services. Their end markets include public and private hospitals, crucial diagnostic laboratories, and vital research organizations. This sector accounted for about 16% of group revenue in FY24, demonstrating consistent, stable growth driven by those fundamental healthcare needs.
Okay, so it's clear they're diversified across different industries, which helps spread their risk and lets them capture different growth trends. That makes sense. But they've also made a very deliberate and significant strategic shift geographically, haven't they? Moving well beyond their traditional home base.
That's a crucial point in their recent history. Absolutely. Historically, Diploma was predominantly focused on the UK and Europe. That was their heartland. However, under the current leadership, they've executed a really deliberate and highly successful pivot towards North America. Big shift. That region now accounts for a substantial 59% of group revenue as of June 2024. Huge. This dramatic shift has been primarily driven by strategic, large-scale acquisitions, most notably Windy City Wire back in 2020 and Peerless Aerospace earlier this year in 2024. Now, if we connect this to the bigger picture, this move drastically reduces their reliance on the more mature and perhaps slower growth European economies. Instead, it significantly increases their exposure to the vast, dynamic, and structurally growing North American market. This offers larger addressable markets and critically more robust long-term growth prospects. It was a bold move, frankly, but it seems to be paying off.
Yeah, that sounds like a really powerful recipe for stability and growth. Definitely. And part of that stability, as you mentioned earlier, comes from the power of recurring revenue. It's not quite like a subscription service, you said, but it's incredibly sticky. What makes it so resilient? Why do customers keep coming back?
Precisely. A significant portion of Diploma's revenue is highly recurring, though, as you rightly noted, it's not structured like a traditional SaaS contract or subscription. Instead, it's driven by the repeated, often non-discretionary need for the mission-critical components they supply. It's about necessity. These are products absolutely essential for ongoing maintenance, repair, and overhaul MRO activities, aftermarket repairs, and consumables for continuous processes. For instance, think of the reagents and specialized consumables required for regular diagnostic testing in their life sciences sector, or the seals that need periodic replacement in heavy machinery in the seals sector. Stuff wears out, needs replacing. Now, the key here is the high switching costs for customers. It's a real pain to switch. While these individual components might represent a low-cost item for the customer in the grand scheme of their overall operations, peanuts relatively speaking, their failure can lead to extremely costly downtime, production halts, safety risks, or even compliance issues. Big problems. Because of these severe consequences, customers prioritize reliability, guaranteed availability, exceptional technical support, and trusted expertise over trying to save, maybe, a few pennies by switching suppliers. It's just not worth the risk. This dynamic creates incredibly sticky customer relationships built on long-standing trust and Diploma's deep technical knowledge. They become partners. So what does this all mean for you? It means Diploma enjoys a highly stable demand profile, one that tends to be remarkably resilient even through challenging economic cycles. It provides a robust and predictable revenue base. It's a powerful competitive advantage, that stickiness.
Okay, so we've covered what Diploma does and how its structure allows it to operate so effectively. Now, let's talk about how it actually grows. Because this company isn't just relying on one way to expand. They've got, as you said, two powerful engines firing at once. This dual engine of growth sounds like a very intentional strategy.
Oh, it absolutely is. And it's a beautifully balanced approach, really well thought out. Their growth strategy combines consistent organic expansion, that's growth from their existing businesses, with a highly disciplined and programmatic M&A strategy, acquisitions. The organic growth component is the resilient foundation. It demonstrates the underlying health of their businesses. You need that core strength. They consistently deliver mid-single-digit growth. For instance, they achieved 6% organic growth in FY24, following 8% in FY23, and an exceptional 15% in FY22, which was, during that post-pandemic rebound period. This proves their existing operations are strong and growing on their own merits. It's not just smoke and mirrors from buying stuff. Then the second engine, acquisitions, serves as a powerful accelerator, a real boost. These inorganic additions contribute significantly to total reported revenue growth, for example. They added 10 percentage points to total revenue growth in FY24 and 8 percentage points in FY23. That's substantial. This balanced approach is crucial because it demonstrates that Diploma is not solely reliant on M&A, which, as we've seen with other companies, can often be a significant risk factor if it's just masking underlying stagnation or problems in the core business. For Diploma, acquisitions turbocharge an already healthy core. It's growth on top of growth.
Right. These two engines aren't just chugging along randomly, are they? It sounds like they're intelligently positioned to ride some massive long-term waves in the market. They're benefiting from what you call structural tailwinds, which seems like a very smart way to ensure durable long-term growth, not just short-term bumps.
Exactly right. That's a key part of the strategy. Diploma is exceptionally adept at positioning itself in markets that benefit from powerful, multi-decade secular trends, big, long-lasting shifts. These are long-term drivers that are largely independent of short-term economic fluctuations, providing a durable growth foundation. They're definitely playing the long game here. Consider aerospace and defense, for example. Their controls sector sees robust demand not just from civil aerospace, which, believe it or not, has a production backlog extending well over a decade for new aircraft, huge demand, but also from emerging areas like space exploration, electric vertical takeoff and landing eVTOL vehicles, and unmanned aerial vehicles, UAVs, or drones. These are all high-growth sectors requiring very specialized components. Then there's data infrastructure. The explosive growth in data consumption and the rapid adoption of artificial intelligence, AI, are fueling a massive ongoing build-out of data centers globally. It's unprecedented. This drives significant demand for specialized low-voltage wire and cable, a key product for businesses like their acquisition, Windy City Wire. And what's more, the increasing power density of these new AI servers is creating completely new opportunities for specialized liquid cooling solutions. That requires components from both their controls and seal sectors. Interesting overlap there. Electrification and automation, another huge undeniable trend. The global transition towards electrification in transportation and across various industries, combined with the reshoring or bringing back of manufacturing and the escalating need for greater industrial automation. Well, that creates sustained demand for a wide range of components, from specialized wiring and connectors to sophisticated industrial automation solutions. They're right in the middle of it. And finally, in healthcare and diagnostics, their life sciences sector is benefiting from fundamental demographic shifts like aging populations, rising global healthcare expenditure, and continuous innovation in medical technology. This includes growing investment in clinical diagnostics, think allergy and cancer, screening the adoption of new technologies such as AI-enabled medical devices, and increased government funding for areas like genetic testing. So yeah, they're not just growing. They're growing in the right places, tapping into trends that aren't going away anytime soon. It's very strategic positioning.
That's a truly powerful combination of factors driving them forward. Really smart. But what about competition? How do they protect this seemingly straightforward distribution business from rivals? What's their competitive moat? Because as you said earlier, they're effectively turning what others might see as a logistical nightmare, managing tons of specialized low-volume parts, into a high-margin defensible business. How do they pull that off?
Right, this is precisely where their competitive moat becomes exceptionally clear. It's not immediately obvious, but it's strong. Diploma thrives in highly fragmented niche markets. They're typically competing against a multitude of smaller regional distributors, lots of little guys. Now, their competitive advantage isn't derived from proprietary manufacturing technology. Remember, they don't invent new widgets, but rather from the unparalleled strength and, frankly, the flawless execution of their service-intensive business model. It's all about the service. They essentially build their moat on three key pillars. First, scale and superior supply chain capabilities. This is huge. Compared to those smaller rivals, Diploma's group scale provides them with superior purchasing power with suppliers, better terms, better access to products. They can also offer broader product availability and operate far more sophisticated supply chain capabilities. This is absolutely critical for customers who need mission-critical components readily available to prevent that costly downtime. Logistics matter. Second, unrivaled technical expertise. Their deep product and application knowledge is a crucial differentiator. It's not just order taking. Customers don't just place an order for parts. They rely on Diploma's specialist teams to solve complex problems, to specify the exact right component for a demanding application, or maybe to troubleshoot issues. This makes them an integral, trusted partner, not just some vendor you can easily swap out. And third, customer intimacy and high switching costs. We touched on this. Their value add model fosters deep, long-term relationships. It builds trust. So for a customer, switching to a new supplier for these mission-critical components, well, it's not just about finding a cheaper price. That's rarely the main driver. It involves a significant risk of operational disruption, the loss of that trusted technical support they've come to rely on, and the time and cost of requalifying new components for their systems. That's a big hassle. These practical, financial, and even, emotional hurdles create a very sticky customer base. They genuinely monetize complexity. They transform this vast number of specialized, low-volume stock-keeping units, which would frankly overwhelm and sink many distributors, into a highly defensible, high-margin enterprise. It's a testament to the idea that sometimes the most valuable things are the ones that quietly ensure everything else keeps working. The unsung heroes.
That makes sense. And a crucial part of any distribution business is not just the customer relationships, but the equally important supplier relationships, right? They can't deliver without strong partners providing the goods.
Absolutely. You've nailed it. In a distribution model like this, strong long-term partnerships with suppliers are just as critical as customer relationships. It's two sides of the same coin. Diploma actively seeks to build these enduring ties. They often secure exclusive distribution agreements to further strengthen their market position and product offering, makes them more valuable to customers. These partnerships ensure reliable access to essential products, allow for more favorable commercial terms, better pricing, maybe, and foster collaboration on technical specifications or even new product development. That keeps Diploma at the forefront of what's available in their niches. However, it's also important to acknowledge the flip side, the potential loss of a key supplier, whether that's due to the supplier's own financial trouble, a strategic decision to go direct to market, or perhaps switching to a competitor that is identified as a principal strategic risk for Diploma. It's something they watch closely. So this highlights the ongoing importance of nurturing a robust and loyal supplier base to maintain their comprehensive product offering and that crucial competitive edge.
Okay, we've seen how their unique model builds loyalty, how they're riding these massive industry trends. But how does all this translate to the bottom line, the financials? Because when we look at their numbers, it's not just good, it's truly, as you said, a compounding engine, isn't it? They have this incredible track record of outperformance. It really stands out.
Their financial performance is, frankly, exceptional and remarkably consistent over a long period. Over the 15 years leading up to FY24, Diploma achieved a compound annual growth rate, that's the CAGR, the average yearly growth, compounded over that period in revenue of 15%. And an adjusted earnings per share, or EPS, of 16%. Very strong, very consistent. What's even more impressive, perhaps, is that this growth has actually accelerated in recent years. Between FY19 and FY24, the revenue CAGR was 20%, and the adjusted EPS AGR was 18%. So they've actually stepped it up. And what's particularly striking is that this strong top-line growth has been accompanied by consistent margin expansion. They're growing and becoming more profitable. Their adjusted operating margin has steadily increased from 17.7% back in FY20 to 20.9% in FY24. And it continued its upward trajectory, hitting 21.5% in the first half of FY25. That's a really positive trend. This ability to expand margins while growing double digits points to significant operational leverage, getting more profit from each dollar of sales as they grow. It also shows strong pricing power, a direct result of that value-add model we talked about, and of course, the successful integration of margin-accretive acquisitions. They're buying profitable businesses. If you look at their 5-year historical financial summary in the reports, the consistent increase in revenue, adjusted operating margin, and adjusted EPS is just a clear, powerful trend of financial strength. It jumps off the page.
It's fascinating how a business of this scale can remain so capital light, as you mentioned. What are the practical implications of that for its cash flow? Because it sounds like a real cash flow machine.
Oh, the implications are profound. It's a massive advantage. The business model is inherently capital light. Their capital expenditures, or CapEx, that's the money they spend on things like property, plant, and equipment, are remarkably low. It represents only about 1.5% of annual revenue. That's tiny for an industrial-type business. This low capital intensity, combined with disciplined working capital management, they focused recently on optimizing inventory levels, for example, results in exceptional free cash flow conversion. What does that mean? It means most of their profit turns directly into cash they can actually use. For example, in FY24, they converted an impressive 101% of their adjusted profit into free cash. That's well above their own target of 90%. Now, this powerful cash generation is the primary fuel for their self-funded M&A strategy. It allows them to acquire businesses without relying heavily on external debt, which reduces risk, and it also supports their progressive dividend policy for shareholders. Think about what this low capex requirement means for a business. Significantly more cash available for strategic growth initiatives or returning to shareholders rather than being constantly tied up in maintaining or buying new assets. It makes them incredibly financially flexible.
Right, that flexibility is key. So they're generating all this cash from this capital-light model. How do they decide where to put it? They must have a really smart, disciplined capital allocation strategy to keep that compounding engine running smoothly.
They do, and it's remarkably disciplined and transparent. Management follows a very clear framework which they communicate consistently. First, they prioritize organic reinvestment within their existing businesses. Investing in their core to drive natural internal growth, that comes first. After that, they focus on programmatic M&A acquisitions, which, as we discussed, is their key external growth accelerator. That's the next priority. Finally, any surplus capital is returned to shareholders through their progressive dividend policy, a clear hierarchy. They also rigorously track their return on adjusted trading capital employed, or OOATCE. It's a key measure for them of how efficiently they're using their capital. In FY24, ROATCE stood at an impressive 19.1%. Management notes this is approximately double their weighted average cost of capital, their WACC. So essentially, you could think of it like this. For every dollar they put into the business, they're getting roughly $2 back in economic value creation. That's very efficient. It means their investments, both organic organic and inorganic, are consistently creating significant value. Furthermore, their balance sheet maintains strong financial flexibility. The net debt to EBITDA ratio was only 1.3x at the end of FY24. That's comfortably below their internal ceiling of 2.0x. This provides substantial capacity or headroom for future M&A without over-leveraging the company or taking on too much risk. They keep their powder dry.
Let's delve a bit deeper into that acquisition strategy then, because it's such a core part of their growth story. Their secret to successful integration. I've heard it described simply as they don't mess with a good thing. Is that basically it?
That sums it up pretty well, actually. Their M&A approach is truly programmatic. It's not just opportunistic buying here and there. It's a core, repeatable process that is absolutely central to their growth algorithm. They target high-quality, privately owned, value-add distribution businesses, and they have specific criteria. These businesses must exhibit strong leadership, there needs to be cultural alignment with Diploma's decentralized ethos, and they must have clear potential for sustained organic growth after being acquired. And they have a formidable track record. They've invested over $1.3 billion across more than 40 acquisitions in just the 6 years leading up to 2024. That's a lot of deals. We can look at a few illustrative examples to see their philosophy in action. Remember Windy City Wire from 2020? The US-based low-voltage cable supplier. Its operating profit nearly tripled in just 3 years under Diploma's ownership. That really showcases the value Diploma's model can unlock, mainly by providing capital and strategic support, but without micromanaging day-to-day operations. More recently, Peerless Aerospace, acquired in May 2024 for $243 million. That's a specialty fasteners distributor. It significantly expanded their controls sector in the U.S., giving them a much bigger footprint in a key high-growth market. Or look at DCSA, acquired in July 2023. A Spanish fluid power distributor bought for $170 million. That strengthened their seal sector in Europe, and the R&G Fluid Power Group acquisition back in April 2022 provided important scale in the UK aftermarket seals business, and it's now serving as a platform for further bolt-on acquisitions in that space. So their post-acquisition approach, as you hinted, is indeed a key differentiator. They leverage that decentralized model. They preserve the acquired business's name, its legacy, and crucially, the existing management autonomy. They don't just rip things apart. They act as a long-term partner, providing capital for investment maybe in talent, technology, or facilities, but crucially, they avoid disruptive integration. They don't impose some rigid corporate template from the center. Now, this approach makes Diploma an incredibly attractive buyer for founders and earner managers who are seeking a permanent and supportive home for their businesses. They feel their legacy is safe, and this, in turn, creates a powerful, self-reinforcing, or virtuous cycle. It works beautifully. The core businesses generate substantial cash. That cash, along with maybe some modest leverage, funds discipline, high-return acquisitions, these new acquisitions are then integrated smoothly into the group and become cash-generative themselves, which then provides more capital for future M&A. And ultimately fuels enhanced shareholder returns. It's compounding in action, a real flywheel effect.
Right, a virtuous cycle. And speaking of shareholder returns, they've got a very clear policy on that too, particularly with dividends. Sounds like consistency is absolutely key for them there.
Yes, absolutely. Diploma maintains a progressive dividend policy. Their stated aim is to increase the dividend per share annually, every year. And this commitment is backed by a really impressive track record of over 20 consecutive years of dividend increases. That's quite rare in the UK market, and it speaks volumes about their financial discipline and their long-term outlook, confidence in the future. For FY24, for example, the board declared a total dividend of 59.3 pence per share, which represented a 5% increase on the previous year. This consistent and predictable growth in dividends signals management's confidence in the group's long-term cash-generating capacity. And it provides a steady return of capital to shareholders, which many investors value highly. It's also worth noting that the company currently does not engage in share buyback programs. They prefer instead to deploy their surplus capital into those growth-oriented M&A opportunities. They clearly view acquisitions as generating higher compounding returns for the business as a whole compared to just buying back shares. It's a strategic choice.
Okay, now let's bring this right into the real world, the recent past. The period from, say, 2022 to 2024 was challenging globally, wasn't it? We had supply chain chaos, soaring inflation, rising interest rates. It impacted businesses everywhere. This must have been a huge stress test for Diploma's model. How did they manage to navigate those pretty significant macroeconomic headwinds?
You're right. That period was indeed a significant real-world stress test for Diploma's business model, no question. Management openly acknowledged operating in a tougher environment. They didn't pretend it was easy. But despite these considerable headwinds, the group's financial performance remained remarkably robust. It really held up well. They delivered exceptional organic revenue growth of 15% in FY22, followed by a strong 8% in FY23, and then 6% in FY24. Still growing solidly. Now, this ability to consistently grow well above underlying industrial production rates, even when many industrial peers were facing contraction or stagnation, well, that really highlights the non-discretionary nature of their products and their strong embedded market positions. It truly shows the robustness of their diversified portfolio and that decentralized operating structure. It worked under pressure. It's really a testament to the fact that when you provide essential products and services, even in a downturn, demand tends to persist. Maybe not booming, but persistent.
It's fascinating, though, how that overall resilience seems to mask some very different stories happening beneath the surface, especially when we look at the sector-specific challenges and performance. This really is the true beauty of diversification in action, isn't it? One part cushions another.
You've hit on the critical point there. Yes, the overall group resilience did indeed mask varied performance at the sector level, and that in itself is a testament to the effectiveness of their portfolio strategy. It's designed to do that. The seals sector, with its higher exposure to more cyclical industrial and construction end markets, definitely faced the most significant headwinds during that period. In FY24, it delivered only modest growth. It was impacted by project delays, particularly in UK infrastructure. Things like mining and rail projects got pushed back. And there was widespread inventory destocking by customers in both European and US manufacturing sectors. Customers just ran down their existing stocks instead of ordering new ones for a while. This trend continued into the first half of FY25, where the seals sector actually reported 0% organic growth. Flat. However, management's strategic response here was quite indicative of their long-term mindset. Instead of resorting to aggressive cost-cutting during this period of slower demand, they actually chose to invest in strengthening the sector's capabilities, particularly in sales and supply chain management. They used the quiet period productively. The idea was to strategically position it for accelerated growth when market conditions inevitably improve, planting seeds for the future. Conversely, the controls sector was the absolute standout performer. It delivered 10% organic growth in FY24 and then accelerated even further to an impressive 16% in the first half of FY25. Really strong. This outperformance was largely driven by those structural tailwinds we discussed earlier in aerospace, defense, and data infrastructure, which remained largely insulated from the broader economic slowdown. Similarly, the life sciences sector delivered solid results. It achieved 6% organic growth in the first half of FY25. Propelled by market share gains in medtech and in vitro diagnostics markets. Steady growth there. So this dynamic where weakness in one area is effectively balanced by strength in another acts as a natural hedge. It smooths out the earnings profile, and it allows the group to continue compounding shareholder value even when parts of its portfolio are navigating challenging conditions. It's like having a well-tuned engine with multiple cylinders firing, even if one is misfiring slightly.
Okay, so looking ahead then, where does management see the next big opportunities for growth coming from? They're talking about identifying white space opportunities. It sounds like they're always scanning the horizon, looking for new avenues to expand.
Yes, management has a very clear vision for building scalable businesses, and they have indeed identified significant white space untapped potential for continued growth within its existing businesses. This organic growth potential is then strategically accelerated by those targeted acquisitions we keep mentioning. They seem to organize the strategy into three primary buckets for driving organic growth. First, end market expansion. This involves deepening their penetration within the markets they already serve and also expanding into closely adjacent ones. A prime example is that growing data center market. Multiple Diploma businesses are developing and supplying specialized solutions there, like components for the emerging liquid cooling systems needed for these power-hungry AI servers, finding new problems to solve in growing markets. Second, geographical penetration. This focuses on expanding the geographic reach of their businesses, taking what works somewhere and doing it elsewhere. That strategic pivot towards North America, which we discussed, is absolutely central to this. Recent acquisitions like Peerless Aerospace provide a much larger platform from which to drive organic growth across the vast U.S. market. Lots of room to grow there. It's about taking a proven model and applying it in new, fertile territories. And third, product extension. Here, the goal is to broaden the range of products and value-add services they offer to their existing customers, selling more to the customers they already have. This aims to increase their share of wallet by providing new solutions for emerging trends, things like electrification and industrial processes, or new components for smart building technologies. They're constantly asking, essentially, what else can we do for our current trusted customers? What other problems can we solve for them?
And alongside pursuing this growth, they've also consistently expanded their margins, as you pointed out. That's such a powerful sign of operational efficiency and pricing power, isn't it?
It is indeed. It's a very positive signal. The group has demonstrated a consistent ability to expand its adjusted operating margins over time. These margins have increased by a cumulative 190 basis points, that's 1.9 percentage points over the past 2 fiscal years alone, reaching 20.9% in FY24. And that trend has continued into the first half of FY25, with margins rising another 190 basis points year over year to hit 21.5%. That's really strong progress. It shows the model's working well. Now, future margin expansion is expected to be driven by several key factors, primarily operational leverage. As revenues grow on what is a semi-fixed administrative cost base, a greater portion of each additional dollar of gross profit should flow directly through to the operating profit line. That naturally boosts profitability faster than revenue. Secondly, there's a favorable mix shift at play. We're seeing stronger growth in the inherently higher margin controls and life sciences sectors relative to the SEAL sector. That naturally lifts the group's overall average margin profile. And lastly, their accretive acquisition strategy explicitly targets businesses that are margin enhancing. They're buying businesses that are already profitable or can be made more profitable, ensuring that inorganic growth also contributes positively to overall profitability. It's a multifaceted approach to improving margins.
Right. So all of this points to a really confident outlook from management, doesn't it? Those are pretty ambitious strategic targets. Seems like they're not shy about what they expect to achieve going forward.
No, they certainly project confidence, backed by that track record. Reflecting their strong performance and that clear strategic vision, management actually upgraded their guidance for the full year FY25 after releasing their half-year results. That's usually a good sign. They now expect to deliver organic revenue growth of approximately 8%. That's an increase from a prior forecast of around 6%. And they're targeting an adjusted operating margin of approximately 22%. That's up from their previous guidance of around 21%. So expecting both faster growth and higher profitability. Now, this upgraded guidance is fully consistent with the company's standing long-term financial model targets, which are pretty ambitious themselves. They aim for organic revenue growth of 5% or more year in, year out, total revenue growth, including M&A, of 10% or more, and adjusted operating margin consistently above 20%. Free cash flow conversion of 90% or more, and that return on adjusted trading capital employed, ROATCE, in the high teens. Now, the crucial thing is their consistent track record of meeting or even exceeding these ambitious targets year after year. That lends a high degree of credibility to their strategic plan and their future financial projections. It builds strong confidence in their ability to continue executing on this successful growth formula. Past performance isn't a guarantee, but it certainly helps build trust.
All right, let's get to one of the big questions then. One that always comes up with these high-performing, high-quality companies, the premium price tag, the valuation. Diploma trades at a significant premium to many of its peers. Why is it so expensive? What justifies paying up for this stock?
That's a critical point, absolutely. And it's where the market's high expectations really meet the company's stellar performance. Diploma shares do trade at a substantial premium, both to the broader industrial sector and to most of its direct peers. Just to give you some context, based on their FY24 results, it's trailing price-to-earnings ratio, the PE ratio, which tells you how much investors are willing to pay for each dollar of the company's past earnings, is way up there, approximately 38.0x. That's high. And its enterprise value to EBITDA ratio, if EBITDA, which gives a broader valuation picture, including debt, is around 24.4x, also pretty elevated. Now, when we compare it to similar high-quality UK industrials, perhaps Halma, which is often seen as its closest comparable because of its similar decentralized model, or even companies like Spirax Sarco, IMI, Howden Joinery, Diploma and Halma clearly stand out with these elevated valuations. They're in a different league, valuation-wise. Now, there's a significant debate around whether this premium is justified. The bullish case argues quite reasonably that it is well-deserved. The market sees Diploma's superior financial profile. That consistent double-digit earnings growth, the capital-light business model, exceptionally high free cash flow conversion, and proven resilience through economic cycles, and believes it simply warrants a higher multiple than more cyclical, lower-growth industrial companies. It's a quality premium. Investors are willing to pay up for consistent, high-return growth and predictability. However, this raises an important question from the more cautious or bearish perspective. This valuation basically prices in near-perfect execution and continued strong growth for the foreseeable future. There's no room for error baked in. So, any significant misstep, whether it's a major M&A failure, a sustained slowdown in organic growth, perhaps an unexpected erosion of their high margins, could potentially lead to a substantial derating of the stock. The higher they fly, the harder they could fall if something goes wrong. Understanding this premium helps you grasp the market's extremely high expectations for this company and just how sensitive the valuation might be to any deviation from its, frankly, pristine track record.
Right, high expectations mean high pressure. And with great growth comes great risk, as they say. Right, they're clearly doing a lot of things right, obviously. But what are the key risks and considerations that could potentially derail this otherwise stellar performance? Given their heavy reliance on acquisitions for that accelerated growth, that must be a significant area of focus, surely.
You're absolutely right. M&A activity and successful integration is arguably Diploma's single most significant risk factor. Precisely because programmatic acquisitions are such a core pillar of their growth strategy and value creation story. The primary risks here are pretty clear: potentially overpaying for an acquisition in a competitive market, a failure to conduct adequate due diligence, maybe missing some hidden problems, or, critically, an inability to effectively integrate a new business while preserving its value. That "don't mess with a good thing" approach is harder than it sounds. Such failures could lead to the loss of key personnel who don't like the new parent company, loss of customers, or even crucial suppliers from the acquired entity. That destroys value fast. A major M&A failure wouldn't just be a one-off financial loss, it would severely damage management's credibility and could potentially impair the entire value creation model they've so carefully built over the years. It's high stakes. Beyond M&A, talent and capability is another key area to watch. That decentralized model is highly dependent on the quality and the entrepreneurial drive of the leaders running each individual business unit. They need strong local leaders. So, an inability to attract, develop, and crucially retain high-performing talent at both the local operating level and at the group level would directly threaten their ability to execute strategy and maintain that unique, empowering culture. People are key. Cybersecurity, well, that's a universal risk today, isn't it? And Diploma is no exception. A successful cyber attack could lead to data loss, significant business disruption, reputational damage, and potentially large financial penalties. Now, while a decentralized IT structure might, in theory, limit the systemic impact by isolating issues to one unit, it also poses challenges for standardizing best-in-class security controls across all the different businesses. It's harder to enforce standards everywhere. Supply chain disruption is also a constant consideration. Given their reliance on a network of key suppliers, the loss of a critical one may be due to insolvency, the supplier deciding to go direct to market, or switching allegiance to a competitor could disrupt operations and impact revenue, especially for those mission-critical products where availability is paramount. On a broader scale, while remarkably resilient, Diploma is not entirely immune to economic cycles and geopolitical risks. Let's be realistic. A deep or prolonged global recession would eventually impact demand across its sectors. And geopolitical events like trade sanctions, tariffs, or major logistical disruptions could certainly increase operating costs and affect their complex global supply lines. And finally, we need to consider emerging and long-term risks, particularly those related to technology. Management says they are actively monitoring shifts, like the long-term move from hydraulic to electric power and industrial machinery. That could potentially reduce demand for certain types of seals over a long period. Also, disruptive technologies like advancements in wireless infrastructure may be reducing the need for some specialized cable products over time, or perhaps increasingly affordable and capable 3D printing, which could theoretically enable some customers to produce their own components in-house. Well, these could disrupt parts of Diploma's business model over the longer term. They need to stay agile and adaptable to these shifts.
Those are definitely significant risks for any company, even one with such a strong track record like Diploma. But ultimately, a company's success often comes down to the people running the show, doesn't it? The leadership. How do we assess the leadership quality and the corporate governance at Diploma? And there's also been a recent development that definitely warrants attention, hasn't there, concerning their executive team, something quite sudden.
Yes, the human element is absolutely crucial, you're right. And Diploma's long-term success is intrinsically linked to its leadership quality and having robust governance structures in place. The current executive team, led by Group CEO Johnny Thompson since 2019, has overseen a period of truly significant value creation. No denying that. It's marked by accelerated growth in revenue and earnings, that impressive margin expansion we discussed, and the successful strategic pivot towards North America. Their consistent achievement of ambitious financial targets really speaks to a very high level of strategic thinking and operational execution they've delivered. Now, regarding the recent development you mentioned, yes, that did catch the market's attention. It was announced in August 2025 that their chief financial officer, Chris Davies, departed abruptly. The reason given was issues related to personal conduct. Now, while the company made it very clear this was entirely unrelated to financial performance or strategy, the sudden departure of a key executive like the CFO inevitably introduces a degree of uncertainty. It just does. The board has initiated a search for a successor, and the market will certainly be watching the quality of the new appointee and the smoothness of that transition very closely. The CFO role is absolutely vital for maintaining financial discipline and executing that crucial M&A strategy. So it's a point of focus right now. In terms of alignment with shareholders, Diploma's remuneration structure appears very well designed, actually. Executive compensation is heavily weighted towards variable performance-based pay. It's tied to key value drivers like adjusted operating profit, revenue growth, cash flow conversion, and long-term metrics like EPS growth and total shareholder return relative to the FTSE 100 index. So they're incentivized on the right things. Furthermore, executives are required to build and maintain significant personal shareholdings in the company. For instance, the CEO's holding was reported at 1,033% of his salary as of September 2024. That far exceeds the already high 300% requirement. It demonstrates substantial skin in the game and a strong long-term commitment aligned with shareholders. Their corporate governance framework seems robust. It adheres to the UK Corporate Governance Code. They have a balanced board structure with a non-executive chair, the executive directors, and a majority of independent non-executive directors providing oversight. Key committees like audit, nomination, and remuneration are all chaired by and comprised of independent directors, which is best practice. They even achieved a 50-50 gender split on the board by September 2024, reflecting a commitment to diversity at the highest level. And finally, their financial reporting exhibits a high degree of transparency. There are clear explanations of adjusted performance measures, and importantly, these are reconciled back to the statutory figures. That allows for a clear understanding of the underlying business performance, which is critical for investors doing their homework.
Okay, so what does this all mean then? We've taken a really deep dive into Diploma PLC today, a company that truly exemplifies specialized growth, hasn't it? We've seen its unique value-add model that turns seemingly low-cost components into indispensable solutions for customers. Its decentralized culture that fuels entrepreneurial spirit and makes acquisitions work. Its powerful dual growth engines of organic and inorganic expansion. Its incredible financial strength and cash generation. And its resilience even through tough economic times.
Yeah, I think this company is truly a masterclass in how to build a high-quality, compounding growth business in specialized niche markets. It really is. Their ability to deliver consistent growth, expand margins, generate significant free cash flow, and execute a disciplined acquisition strategy is, frankly, exceptional. However, and it's a big however, given its premium valuation, the core question for you as a learner or potential investor is whether its demonstrated superior quality and its future growth prospects fully justify the market's extremely high expectations right now. The company's future success really hinges on its continued, almost flawless execution of M&A, on its ability to attract and retain key talent within that unique decentralized structure as it gets bigger, and its adaptability to those emerging technological shifts we talked about, which raises, I think, an important broader question. In a world of increasing disruption where everything seems to be changing at lightning speed, how long can even the most resilient business models like Diploma's maintain their secret sauce and consistently stay ahead of the curve? It's a challenge for everyone.
That's a really profound thought to end on. It certainly reminds us to look beyond the flashy headlines sometimes, doesn't it? Think about the companies you rely on every single day. How many of them provide such mission-critical but often completely unseen products and services, the things that just have to work? What would truly happen if they suddenly disappeared? Diploma PLC reminds us that the backbone of the global economy is often built on these specialized, indispensable parts and services, quietly compounding value in the background. So you go about your day, maybe think, what other unsung heroes are out there, operating behind the scenes, making our world work without us even realizing it? Thank you so much for joining us on this deep dive today. We hope you found this exploration of Diploma PLC as fascinating as we did. We'll be back soon with another deep dive into the businesses shaping our world.